All right. Hey, welcome back to the Wealth Mindset Show, where the Hixon Zuercher team helps you manage wealth, navigate retirement, and make smart decisions for a secure, meaningful future. I'm Austin Wilson, Director of Investments at Hixon Zuercher Capital Management.
I am Tony Hixon, taking over for host duties, joined by
Jordan Shaw.
He's the
only one I know.
Today, we're diving into something that's a little bit interesting to talk about. It's news headlines of the war with Iran. We're going to talk about oil prices, how they're surging, what could that mean for your wallet markets, the global economy, and then Jordan will weigh in on what that means for you, your investments, your portfolio, and your financial plan. So before we get started, though, let's catch up on what's going on in the families.
What's going on with life?
What's happening right now? Jordan, let's start with you.
Life right now, this is spring cleaning mode,
Yeah.
right, for
Okay.
everyone. So
Nice.
our house is messy, and it's that mess before it gets really nice. So I live in that area a little bit. I kind of like it, the potential to be reset for the summer and the warmer weather out there and getting outside for walks. That's where I'm at. I'm at a peaceful place right now.
Good for you. How's your bracket?
I don't want to talk about that.
Okay. All right.
Avoid it
We'll
at all
on.
costs.
We're in the midst of the NCAA tournament.
Yeah, it's true.
Depending on when this comes out, and Jordan's not going to talk about that.
He's not gonna
Austin,
talk-
what's going on
Same outside weather it's time for. We had 70 degrees last weekend with 70-mile-an-hour winds.
with you? Yes, we did.
Then we got 2 inches of snow,
Mm-hmm.
and now it's 60 degrees and nice out again.
Beautiful.
So the kids are enjoying being outside, and we're enjoying that too. What about you, Tony?
Yeah, so my oldest, sophomore in college, studying abroad in Spain right now. Her major is Spanish education, and she'll be back in a couple weeks. So we're looking forward. She's been there for 4 months.
Yeah.
And she's learned a lot about the Spanish language. Carrie and I were able to head over for a week to visit, and we're looking forward to having her back for the summer. So with that, Austin, as our CIO, you have a lot of responsibility. You have to know a lot about a lot of things, right?
Master of none. No, yeah. There's a lot going on.
There's a lot. So this is not a news episode.
There's no breaking news here.
We're not going to describe the entire situation, but from a high level, what is the Iran conflict? What started all this?
Yeah. So as of the time of this recording, it's been a few weeks now where it's been since really the U.S. took initiative, and really with the help of Israel, to try and put a stop to Iran's nuclear capabilities. That's what this whole thing was started as, is, hey, there's a global threat that Iran has potentially the capability to have nuclear missiles, and we don't think they should, because there's a number of reasons, but a lot of that is they're state-funded terrorism and all kinds of things like that, right? They're bad guys in general. There's probably great people in the country, but the leadership, not so good, right? So the discussion was, well, let's try and take out, through a targeted series of events, their ability to do this. So that's kind of what started this whole thing.
Yeah.
If you think about where Iran is, however, this creates problems.
Okay.
Iran is in the Middle East, which is not surprising, but it is very, very key to global oil production, global oil transport, all these things. And a lot of its neighbors are doing the same thing. They are it's an oil producing area of the world. What this means is that the world energy situation is under a little bit of a threat, right? So about a fifth of the world's oil travels through the Strait of Hormuz, which is right outside of Iran there. It connects a couple of the seas and a couple of areas of the country, and where a lot of the eastern side of the world gets their oil from, right? So this is not the U.S.'s. The U.S. does not get a ton of oil from over there, but the rest of the world gets a ton of oil from over there. And if you cut off essentially a fifth of the world's oil supply, that's a big problem, right? So we've seen oil prices spike, and as of the time of this recording, depending on what you're looking at, 50-ish% of an increase in a barrel of oil. A couple of different ways we can measure that, but it's really a huge jump. This is impacting oil prices here in the U.S. It's impacting oil prices in Europe and around the world. It's impacting gas prices. We're going to talk about that in a little bit. But we've had a significant jump in the price of oil. What is interesting is that when we're watching this, oil prices shot up seemingly overnight, but they've continued to shoot up over the weeks that this has been going on. And they obviously have yet to meaningfully come down. They've kind of come down off of their peaks, but still well elevated from where they were. And if we look historically, these events, unfortunately, these events have happened in the past, right? Yeah. So I think out of the last 14 events that have been similar to this, oil prices have essentially come back down to where they were in a couple months. So we're definitely not a couple months out, and we're still elevated. They should continue to come down. This is not anticipated to be a forever conflict, right? Iran doesn't have the military capability. They don't have the money. They don't have all this stuff to actually continue this as long as essentially the United States does. So that's something we're watching right now, and it's just creating a lot of volatility in terms of markets. I feel like markets are down, mid-single digit % overall. However, if you look individually, there's a lot of volatility in terms of individual sectors, and there are things that are working, there are things that are not working. And any given day, you can be up 2% because there might have been some good news, or you can be down 2% because there might have been a little bit of bad news. So that's kind of what's going on right now.
Yeah. And you mentioned the hit to gas prices. So I happen to kind of remember before this conflict occurred, gas was maybe $2.40 a gallon, maybe in that area. And I think I know this morning I just filled up at $3.79. So Jordan, from a budgeting perspective, that can be quite a hit to a budget when gas price increases almost 100% in a few weeks. What is your suggestion when you run into clients who kind of haven't budgeted enough in certain areas like that when a shock occurs to a budget item?
Look into getting a good two-wheel bicycle is
Live
an
close to
option.
work.
Live close to work. But in all seriousness, alternatives to those energy usage aspects of your life can be something that will need to be looked at. Do you need to drive the vehicles that you are, the places that you go? How much is necessary? And obviously, we're not encouraging people or encouraging ourselves really to, you need to focus on only the necessities, because, like we've talked about, this may not be a long-term thing. Typically, this is only kind of a blip when you zoom out and look at everything. But obviously, we're feeling it today, right now. What do people need to do? And it's look into where you can cut back on the things that you maybe didn't even realize that you had a 5-year subscription to some protein shake that you didn't care about. You know what I mean? So there's things like that need to be certainly looked at all the time, and especially in moments like this where spending that you need for energy, utilities and things that you're going to be paying for regardless, just to live your life. When that goes up, other things kind of come under some pressure and need to be looked at.
Yeah, and Austin, if you're right, maybe gas prices will start to recede in the summertime.
Yeah, but the challenging thing is that we have two things going against us, right? We have the shock that is oil spike causing gas price spike, and gas prices go down a lot faster or a lot slower than they go up, of course. So we're going to probably see that, but we're also running into seasonality of gas prices, right?
That's right.
So in the winter, gas prices are low. Not a lot of people are driving. And then through the spring and into the peak of summer, gas prices rise. So we're actually fighting an already probable increase of gas prices on top of a shocked increase of gas prices. So will they go back down? Maybe a little bit, but I wouldn't count on it anytime soon to be substantial. Yeah. And that's unfortunate. And there's a really key level. If you look at consumer, sentiment, mentality of how consumers are feeling, you get to that $4 a gallon range, which we're not quite there yet. Depending on where you are in the country, you might be, but we're not right here in Ohio. That's a mental trigger where people start getting a little bit more freaked out. And if it stays above $4 a gallon for a while, I think we'll start to see more sentiment issues. As of right now, it's not. And not even on a national basis. So it's something to keep our eyes on.
Yeah. Well, energy prices, gas prices, they obviously drive inflation higher, right? So what do you think the Fed is thinking about the possibility of inflation going higher from here? What will this do for rates and our economic situation?
So if we looked going into 2026, the markets would have been saying, and the Fed themselves would have been saying, yeah, you're probably going to get a couple interest rate cuts. Yeah. And that's kind of what everyone's base case was going into 2026 and even, into February. Then all of a sudden March comes and this happens and things change. The data changes. The data changes in the short term. So we haven't seen actually this hit the actual published inflation data yet. Right. It's going to. But what the Fed wants to see is 2% inflation. That's what they've talked about for a long time. There's a lot of reasons for that and a lot of maybe thoughts why that might not be as relevant anymore. But what I think is going to do, as you look today, the markets are now pricing in no cuts. So the markets are saying the Fed's probably not going to cut, and that's because inflation's probably going to creep back up a little bit with some of these inflationary shocks from some energy prices. But the Fed's probably not going to be increasing rates in the face of this because there's a couple things. Number one, this is a relatively short-term event. This is a relatively isolated event. And this is a supply-driven event, right? So we're choking off. We're not. the Iran essentially right now is choking off the world's supply of oil by a significant margin right now. So they're controlling the supply. Supply is limited, but demand's relatively the same around the rest of the world. So that makes prices go up. What the Fed can do with interest rate moves is control the demand side of the equation. They can make things more expensive to borrow money, to buy things on interest and things like that. They can make money flow slower, which makes the demand side of things a little bit weaker. They cannot control supply. They cannot open up the Strait of Hormuz. They cannot make oil cheaper and gas cheaper. So I think that, they can't do that. So they can control what they can control, and they can look at this and say, well, this isn't really something we can fix right now. So I don't think this is really going to change they're not going to hike, rates in the face of this. But what it does is probably just allows them a little bit more patience as inflation already was a little above where they wanted to be, to not be cutting rates in the face of this. So the Fed's in a tough spot because the other side of their mandate, in addition to price stability, which is the inflation side of the mandate, is the labor market. The labor market it's okay. I'm going to say like soft okay. It's certainly weakened from where it was a year or two ago. We have less job openings and higher unemployment rate, certainly. And all of this is kind of being masked by some changes in demographics, some changes in the labor pool, and honestly, great productivity. And a lot of this is coming from things like AI. So the labor side of the market is actually weaker than the inflation side. So they have one thing running hot and one thing running cold. So what are they going to do if they have conflicting signals? Probably nothing.
Yeah.
So I think the Fed's going to be probably waiting for a while on this.
Makes sense.
Have you ever thought about how your financial choices reflect what truly matters to you? At Hixon Zuercher Capital Management, we believe that integrating your values and dreams with your financial future is key to achieving peace of mind and confidence. When you engage in deep conversations with us, you'll start to see how your money can support the things that matter the most in your life. Our holistic approach means that your financial plan is more than just numbers. You'll have a dedicated team of professionals tailored to your unique needs, all focused on crafting an investment portfolio designed to help you achieve your specific goals. Plus, our on-staff retirement life coach offers guidance to empower you toward a fulfilling retirement that goes beyond just financial security. Ready to transform your relationship with money? Join us at hzcapital.com and let's embark on this journey together. Now, back to the show.
So Jordan, inflation is kind of, we call that the silent killer to a retiree's portfolio. If you're living on a fixed income or you're not invested in such a way as to keep pace with inflation, it can really affect a financial plan or a retirement plan. So in the face of a probable inflation as a result of the increase in gas prices, how are you talking to your clients? How are you building confidence into them that their plans will be okay?
Yeah, and there's really kind of two things that come to mind. The first is to directly answer that question. We're accounting for, and every good advisor should be accounting for, inflation happening in general.
That's right.
So that's something that when you're investing, you are making sure that the long term is going to be through all the historical data you can find and the best investments you can put together, hopefully outperforming whatever inflation does, so that you can continue to take from your portfolio to provide for your lifestyle in a way that, sure, you may feel the day-to-day increase in costs, but the portfolio is doing what it is set to do, and you'll continue to be able to use that as a source of funds. And there's other things too, like those that are drawing on Social Security, that increases right now according to inflation. So there are some other fixed income sources and some pensions that people have that will help hedge against that just naturally by the way they were built, which is a good thing. And the other thing that comes to mind too is looking kind of globally at this and each country and how this is going to impact inflation. I'm curious, and maybe this is more of a question to you, Austin, too. Like this instance of what's happening, it's really targeted a single item, a single or group of items, gas or liquid natural gas and oil, right?
Yep.
Versus other economic issues or global issues that have happened and have hit a wide range of different things that might spike inflation a certain way. So I'm curious, do you have thoughts on how that, even though it's just one thing, how it's still trickling down and rising costs?
Yeah, I mean, simply put, energy costs they impact everything, right? So if transportation costs are higher because fuel costs are higher, plane tickets are going to be higher because jet fuel's higher. You've got trucking costs, which are going to be higher. You've got shipping costs around the world, which are going to be higher. as well as manufacturing costs are going to be higher because if you're using oil to make things like plastic, asphalt, all these other things that go into the manufacturing of the products, in addition to the transportation costs, that's where you start to see a little bit more of a sustainable impact. It's just going to take time to flush through all the different levels all the way to the end consumer there. So that's why I think it could be a little bit of a, while it's supply-driven shock for energy prices, it could be a more lingering impact in terms of just a slight tick up that might stick around a little longer than we thought. Because right now, obviously, all the oil that people are buying around the world, they're buying at elevated costs, and that should, and as the way economics work, it's going to get flushed through to consumers and or profit margins of some companies. So that's something we're watching right now. So it does not just impact the gas pump and oil prices in general. There are so many different components there. But I do think each level probably gets a little bit more and more diluted as you get down there. So it's not like a 50% price in change in oil is not going to make your gallon of milk cost 50% more. It might make it cost a couple cents more or whatever.
Yeah, I think that's kind of leads into the idea of the short-term versus long-term energy shift. So
yeah.
I would say, I think we would agree this is a short-term.
Yeah, correct. Absolutely.
Correct. So maybe dig a little bit deeper as to why we think it's that way, and maybe dig a little bit deeper too on domestic production and how we've recently, the U.S. has become a net exporter recently. Talk a little bit more about our less dependence on oil.
So if you look back over the last 20 years or so, the U.S. has gotten to the point where we have become a net exporter of oil, meaning we drill and acquire more oil naturally here than we import. That's a really good place to be. And that's why oil priced in the United States, the way we would look at West Texas Intermediate and stuff like that, had been less impacted than global oil like Brent crude and stuff like that. So we are more energy independent than we ever have been before. What this means is that we have the ability, to the extent that we have refining capacity, because refining capacity does take time to change, but we have the ability to be less dependent on specifically Middle Eastern oil than the rest of the world is. So places like China, places like Europe, a lot more dependent on Middle Eastern oil than we are right now. But this has been a shift that's been occurring over 20 some years, and we've just finally, over the last handful of years, gotten to the point where we are in a much better position. If this would have happened in, say, the 1970s, where we already had a giant oil shock, a lot of that was because we were not energy independent. We were wholly dependent on oil coming from places like the Middle East. And I think that made things a lot more steep and severe and long lasting of an impact that I don't think we necessarily have the chance of right now.
Yeah, that's true. So it seems like any given day, I turn on our TVs. How many do we have? 12 or 15 TVs
yeah, probably
in the
a lot,
office.
Yeah.
They're all set to CNBC, and I'm seeing 200-point down days, 300, 400-point down days. This can be very unsettling for investors, right? And so, Jordan, as you talk with your clients, how do you help them stay grounded and avoid those emotional decisions, which would be like, I need to get out of the market, or what are you doing for me, wanting to churn the portfolio? What kind of conversations are you having with your clients on that?
Yeah, the first part of that conversation is just listening, because everyone has a different perspective on these types of things that happen. Some people are very well informed and will say, you know what, I'm not worried about it. It's going to be short term or whatever it is. They're maybe very optimistic about it, and there is no emotional decision for them. They have maybe they've been through similar things in the past. And then of course there's clients who are understanding what's going on and maybe feeling the impact a little bit more, or they're more dependent on a portfolio. And there are those emotional conversations trying to work through what does this mean for them. And after listening and understanding where those individuals are coming from, it's important to reiterate the fact that when you're in the midst of an emotional conversation or emotional situation, you typically do things that are not characteristic of what you truly believe at your core. And those who work with us share a lot of our core investing principles and beliefs too, and understand that. So it's just kind of guiding the conversation back to that, saying, you know what, this will happen. This is incorporated in a lot of ways into the plan that we put together for you, into how your investments are set to perform. And it's expected. The volatility is expected. Unfortunately, it's just how the world works that we live in right now. And another piece of the conversation that can come into play is if clients really want to do something about it because there is an action. Like, we're doing a lot here, but sometimes clients want to do something as well. I don't want to say it's just a distraction, but it can be a healthy distraction too. Instead of looking at how is this going to impact me and what can I do, start asking the question to what can I do to help this situation? And those who have the means to perhaps look into and research the different nonprofit organizations out there, Doctors Without Borders or Red Cross, just well-known organizations that are out there trying to aid in the peace process, that helping the people that are in need in times like this. And that's something that can provide a lot of value to clients. It's not dollars related, it's not portfolio related, perhaps in some ways, but it addresses a deeper thing that, there's human beings at the core of all this that are being impacted. So
yeah, very well said. And it is easy to forget that when we're looking at news headlines and the Strait of Hormuz and a big conversation on oil and all that kind of things. There are humans involved, and so it is important that we keep that in mind and that there's a need out there to help support. So, Austin, last thoughts on I think we're down maybe 4%, 5%,
yeah, 4 to 5
all-time highs.
Mm-hmm.
It's not
maybe a little bit more after
extreme,
today, but yeah.
Last 3 years we've been up 15+%
right.
last 3 years, and so a lot of clients or investors have been lulled to sleep. This is easy, right?
Make money by doing nothing.
Yeah, I think there's a chart that we like to pull up from time to time on the intra-year declines versus calendar year returns. Maybe lean in a little bit of that. Is this expected? Is it?
Yeah. So I guess one thing to point out is that we've had these geopolitical events happen seemingly every year forever, right? If we remember just a couple years ago, we had Russia invading Ukraine. That obviously caused its own oil spike and all these other things. But if we look back historically, these things have been relatively short-lived, aside from world wars. Again, we're not comparing to those, but these sort of events have been relatively short-lived, and markets have recovered. If we look at intra-year decline historical probabilities, we can really expect, as investors in large-cap U.S. stocks, about a 10% correction about once a year, on average. And that is no fun. And I kind of feel like the markets feel like they're there already,
but they're
even
not.
though they're not. And that's because you get a little bit of good news, and markets are up about 2% to make up for some down that they've had. So could we get this to go down a few more percent and hit a 10% correction? Absolutely. But that's doing that on the back of, like you said, 15+% S&P 500 return years. Great years in the market. Everyone is still sitting on tons of gains if you've been invested for any significant amount of time. And that's absolutely normal. And honestly, it's pretty healthy because you can't just go up into the right forever. Things get overbought. Expectations become unrealistically high, and it's time for some digestion. And if you get a 10% pullback to get some of that digestion just pulled forward, that can actually lead another leg higher for the markets. So this is nothing new. One thing that we would continue to focus on is diversification, right? You can't have all your eggs in one basket. If you're just holding technology stocks, you're probably not real happy right now. If you're just holding oil stocks, you might be right now, but you wouldn't have been for the last 20 years. This is why we would say across sectors, you should be diversified. Across asset classes, you should be diversified. Even within equities, the U.S. is great, and we love the U.S., and we're hometown biased people, right? Mm-hmm. But you got to have some exposure to things outside the world because that side of the world has held up better in terms of the market this year. Fixed income's obviously had its place too. It's flat for the year-ish kind of right now, so doing better than equities. As well as areas like small and mid-cap stocks have outperformed U.S. stocks or large-cap stocks this year. So this is where I think just making sure that your financial picture is sound, your plan is sound, your asset allocation with your advisor is sound, it certainly is going to pay dividends.
For sure.
Pun intended.
I'm hearing stay calm. I'm hearing
stay calm.
Stay invested.
Yeah.
I'm hearing care for others, and this is an opportunity if you're a younger investor to put some money into the market at a 5% discount. Right?
Absolutely,
you're buying some things on sale. So we appreciate your time and listening to this episode. It was fun to kind of debrief about what was going on in the Middle East. If you found this helpful, don't forget to subscribe so you never miss an episode of the Wealth Mindset Show. Visit thewealthmindsetshow.com for more resources, and if you're ready to invest with us, head over to hzcapital.com. Thanks for listening, and we'll see you next time.
Bye.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hixon Zuercher Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hixon Zuercher Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hixon Zuercher Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.